ICI, Chairman, Ethical Standards Board, ICI, Convener, Publication and CDS Directorate, ICI, Vice Chairman, Sustainability Reporting Standards Board, Vice Chairman, Taxation Audits Quality Review Board, and member of various non-standing committees of ICI. He is dynamic Central Council member who is always with the prime objective to serve the members of ICI at large and always stands with and for the members of ICI. He had earlier served as a chairman CIRC of ICI, as chairman, and in other positions of CIRC of ICI and chairman in the Hyderabad branch of CIRC of ICI. We are very happy.
Madam, you are mute. You are on mute.
Able to hear now, sir?
Yeah.
So we're very happy to introduce our chairman, CA Dr. Anuj Goyal, sir, and very happy that we are seeing him through the live webinar today. We had him in our branch a few months before as well. Thank you so much, Anuj, sir, for this session. Over to you, sir.
Thank you very much. I am really very happy that we are having this very important BCM on this very important topic, how to improve the financial skills of the chartered accountants. We are having very important resource person, and of course we are having the event enabler. We are having chairman of the Madurai, Jaya Kirtika ma'am. We are having Satish Kumar sir and CA MBS, the secretary of the SIRC, T Mani Meghali ma'am, and Anmandhan R from Madurai ji. And I'm really very happy that we are having more than 2,000 participants from each and every part of the world. We are having Dr. Sabir Mishra ji, our secretary of this committee, and of course Sri Priya ma'am, our vice chairperson, will be joining us. I'm really very happy that we are having the best of the resource persons. Madurai branch is very prominent branch, and we are having the event enablers, and through this professional skill management committee, we want to see that how we can really do something very concrete to further enrich the skills of the best of the accounting professionals, the best of the chartered accountants. And for the first time in the history of the ICI, we got this mandate to have the professional skill management committee, and we are trying our level best to see that how we can improve various skills, including interpersonal skills, the financial skills of the members of the Institute of Chartered Accountants of India. I will not be taking further time, as we are very eager to hear our learned guest speaker on this very important topic. I once again welcome all of you on behalf of the Institute of Chartered Accountants of India and as chairman of this very important professional skills enrichment committee of ICI. Happy learning. Thank you very much.
Thank you so much, CA Anuj Goyal, sir, for the welcome note. We also welcome our Vice Chairman of Professional Skill Enrichment Committee in absentia, CA Sri Priya Kumar ma'am as well, and our speaker for the day, CA Dinesh Chawla sir as well. So before we get into the actual program, we'll be having the objective of this program by the Vice Chairman and Secretary of Madurai Branch, CA Chairman R.
Thank you, madam. So I'm happy to share that the objective of the program. Financial planning encompasses various aspects, including budget, investment planning, risk management, tax planning, retirement planning, and estate planning. CAs possess a comprehensive knowledge and expertise in these areas, enabling them to provide a holistic financial guidance to their clients. CAs assess the financial health of an individual or the business by reviewing their income, expenses, assets, and their liabilities. This evolution helps them in identifying the areas of improvement, potential risk, laying the foundation for an effective financial planning. Based on their clients' aspirations, CA assists in setting a realistic and achievable financial goals. They consider factors such as an income, savings, investments, and a risk appetite to develop personalized strategies that align with a client's objectives. CAs aid in creating a budgets and managing cash flow effectively. They analyze income sources, expenses, financial commitments to optimize the cash flow, control spending, and ensure financial stability. CAs provide a valuable insights and recommendations on investment opportunities that align the client's financial goals, risk tolerance, and time horizon. They assess the potential risks and returns of the different investment options, empowering clients to make an informed investment decisions. And CA also engage in the risk management and insurance, tax planning, and retirement on estate planning. This program objectives enrich and financial planning skills for an CAs. I, on behalf of the Professional Skill Enrichment Board, ICI, wish a great learning experience for all.
Thank you so much, Vice Chairman and Secretary, CA Chairman R. Now it's time we get to know about our speaker. So may I request CA Hanumantan R, immediate past chairman, Madurai branch, to introduce the speaker for the session, CA Dinesh S. Chawla.
Very good morning to all. So this is my privilege to introduce speaker of the webinar, CA Dinesh S. Chawla, an enthusiastic and vibrant individual with varied skill sets and knowledge of valuation of private enterprises and mentor to startups. Currently aiming to progress in the field of wealth management related to private banking in enhancing client portfolios. He has about 7-year experience in financial planning and wealth management. With this figure, I happily introduce CA Dinesh S. Chawla before the participants. Thank you.
Thank you very much, sir.
Thank you so much, Hanumantan sir. Now it's time to hear from our speaker on the topic financial planning skills for CS.
Thank you, ma'am. Thank you very much. Hope I'm audible.
You are audible, sir, but could be even more louder also.
One moment now. Just a minute. Is it better now?
Yes, sir.
Yeah. Thank you. I'll just put my screen. Let me know when it is visible, please.
It's visible, sir.
Thank you, ma'am. Very good morning to everybody. Thank you for this opportunity for allowing me to speak on this very important topic in today's world of financial planning. My objective today will be to try to make things simplified when it comes to the word financial planning. There is a lot of confusion, a lot of wrong thoughts, a lot of right thoughts happening in the market when it comes to financial planning. So I'll just start off with a small analogy on this topic. Life is very uncertain, and the inevitability of the mortality are the fundamental aspects of the human experience. Death is the ultimate certainty, serves as a stark reminder of life's fragility and impermanence. Rather than avoiding these harsh truths about life, it is essential to confront these truths head on. While we cannot alter the course of life or evade death, we can adopt a proactive approach to how we can navigate these realities. Both life and death hold profound significance, demanding thoughtful consideration and preparation. While we cannot control the timing or the circumstances of either, we can manage our responses and plan accordingly. By embracing this perspective, we empower ourselves to live with a greater intentionality and purpose, making the most of our time while acknowledging the inevitability of our eventual transition. Through careful planning and mindfulness, we can navigate life's uncertainties and prepare for the certainty of death. ensuring that we approach both win, grace, resilience, and sense of fulfillment. With this, let us deep dive into today's agenda. I will be speaking today on financial planning skills, which are required for a professional in progressing this as a practice. And in order to achieve that, we also should never forget that we should do the financial planning for ourselves and our family members. I will be taking few minutes in explaining the basics of financial planning and another few minutes in giving a broad overview on what are the steps involved in the financial planning. I'll also be covering on the educational qualifications and the institutions which offer these financial planning courses in India and across the globe so that we can add the educational touch to our planning aspect. Moreover, I will also touch upon the learning, unlearning, and relearning of some skills which are of great importance when it comes to financial planning and what could professionals do to keep themselves updated and keep improving their existing skill sets. How financial goals can be set in a realistic manner for oneself and for our clients. Also, as a side note, in today's session, I will try not to teach how to do financial planning. We chartered accountants are mostly experts in that. I repeat, I will not teach on how to do financial planning, but I will strengthen you, I will strong arm you with the relevant skill set to make some goals, to make a plan, and to take charge of your life back. So, with this, I will step into the topic on steps in basics of financial planning. We as individuals, most of the time, fail to plan. We underestimate the power of compounding. We also underestimate inflation. And we also sometimes enter into a debt trap, ultimately. We also have some confusion between savings and investing. When this happens, we try to be risk averse, meaning we try to avoid risk. But we always know that in avoiding risk, there are a lot of accidents which may happen by ending up getting lesser returns. And we know that history repeats itself. So, with this, as individuals, we often find ourselves navigating the complexities of personal finance without a clear roadmap. Despite the undeniable benefits which are available for financial planning, many of us fail to prioritize this crucial aspect of our lives, whether due to procrastination, due to lack of knowledge, or competing priorities. The absence of a concrete plan leaves us vulnerable to financial instability and missed opportunities. One common oversight is underestimating the power of compounding, as I was explaining. So, most of us are aware from our learnings, educational background, and our client advisory on how power of compounding works. So, compounding interest is often known as the eighth wonder of the world and has the potential to exponentially grow the wealth over time. It is a boring task if we try to plan for it, but it is the ultimate wonder of the world. Yet we frequently overlook its impact, neglecting to start saving and investing early, or failing to consistently contribute to the retirement accounts. By ignoring compounding, we forfeit the opportunity to harness the transformative effects of our financial future. Similarly, we tend to underestimate the corrosive effects of inflation. While seemingly insignificant in the short term, inflation erodes the purchasing power of our money over time, as everybody is aware. This diminishing value of savings and investments falling to account for inflation can lead to a false sense of security and derail the long term plans. Just for example, today in India, inflation is running around 5.5 to 6% of the real numbers, whereas the interest rate which we get from an ultra safe T bill or a T bond, it is currently running at 7.25%. So effectively, if you remove inflation from the fixed deposit interest rates, which is available at 7.25 for 1 year, you're effectively making only 1%. In today's terms, globally, when you compare, we are at a far better place as a country, as a nation, than many other nations. Our attitude towards debt often contribute to financial mismanagement. While debt can be a useful tool for achieving goals such as home ownership or education. When it becomes excessive, it gets mismanaged and becomes a burden, hindering financial progress and limiting the opportunities for wealth accumulation. Moreover, confusion between savings and investing is always a commonplace. While both are essential for financial health, they serve as distinct purposes. Savings provide liquidity and safety for emergencies, while investing offers opportunities for the potential of growth and wealth creation. Failing to differentiate between the two can result in suboptimal resource allocation. To slightly better this, when we tell that we are saving, we should ideally save only for emergencies, while all the other aspects of savings should translate into investing. Investing is to make your returns better. Savings is purely for your emergencies. When we have all this in place, we always tend to be risk averse, meaning we try to avoid risk as much as possible. That is why when you speak to most of your clients or even plan for yourself, instead of having a long term view of 10, 15 years of investing, we ideally take a conservative view of putting the money in a fixed deposit or parking it in an RBI bond. There are various instruments in the debt side of things. We don't try to suboptimally allocate between debt and equity. That is why our risk aversion can stifle our financial growth. When prudent risk management is essential, excessive aversion to risk can lead to missed opportunities for higher returns and long term wealth accumulation. Lastly, the belief that history repeats itself can lead to complacency and misguided decision making. While historical trends can provide valuable insights, they do not guarantee future outcomes. Failing to adapt to changing circumstances and market dynamics can leave us ill prepared for our evolving landscape. To conclude this slide, overcoming these common pitfalls requires a proactive approach to financial planning, a commitment of ongoing education, and a willingness to adapt to changing circumstances by acknowledging the power of compounding, accounting for inflation, managing debt wisely, distinguishing between investment and savings, embracing calculated risk taking, and remaining adaptable in the face of uncertainty. We can empower ourselves to achieve the long term financial security and success. Let us move forward in understanding some more steps in the basics of financial planning. We, as individuals, as human beings, are mostly underprepared for our losses. These are contradictory statements, by the way, which you see it on the screen, but I'll explain you in a minute on what this means. We are filled with overconfidence. So, can you see the difference? We are underprepared for losses and we are always overconfident. So, these are all contradictory aspects. We are scared for changes. When it comes to changing our mindset, when it comes to changing anything, even the slightest change from Windows 10 to Windows 11 took time for us. So be it. When that takes time, we are similarly attached emotionally with money as well. And we are very good at procrastinating. And we are very good at doing what if analysis. We as chartered accountants for ourselves lack discipline when it comes to our own financial planning, barring a very few people. And when this happens, we always lack patience. It is like investing money today and expecting doubling it in 1 year time, which is not happening across the world, which will never happen in reality. And we try to run away from our reality with multiple biases. To put these aspects to a slight context, let me reiterate this. As individuals, we often find ourselves navigating the complexities of personal finance without a clear roadmap. Despite the undeniable benefits of financial planning, many of us fails to prioritize this crucial aspect of our lives, whether due to procrastination, whether due to lack of knowledge, whether due to competing priorities, and in the absence of a concrete plan, which leaves us vulnerable to financial instability and a lot of missed opportunities. Common oversight is underestimating the power of compounding interest, right? Which I had discussed in the earlier slide.
Dinesh sir.
Hello, hello. Can you hear me now? Hello.
Yes sir. Yes sir.
Sorry, the audio was lost. I think there was some issue with my Wi-Fi.
No issues sir. Please go ahead.
Your audio is not there, sir.
Hello, hello, hello. Can you hear me now? Hello.
I am. Right now we are hearing.
Yeah. Just a second, sir. Just a second. My screen is visible, right?
Yes sir. Yes sir. Your
Yeah.
screen is visible and you're audible.
Thank you. So yeah, what I was saying is when I'm continuing from the previous slide, we are always ill-equipped to handle some financial losses, despite the inevitability of certain setbacks and market fluctuations. We frequently underestimate the potential of losses and fail to prepare adequately. This lack of preparedness leaves us vulnerable to financial shocks and can derail our long-term financial plans. Moreover, overconfidence can cloud our judgment and lead to risky decision making. Believing that we are immune to financial downturns or market volatility, we may take sometimes excessive risk or we may fail to diversify our investments, exposing ourselves to unnecessary losses. Fear of change is another common barrier to a financial success. We may resist adapting to new economic realities or evolving life circumstances, or we may be clinging on to our familiar but outdated strategies that no longer serve our best interest. Sometimes what happens is we get emotionally attached to money and further complicate our financial decision making. Sometimes, and most of the times, you will agree with me that this attachment and emotional attachment to money is predominantly driven by fear on one side, that is the one extreme, and greed or sentimentality on the other side. So when we try to invest, we never try to balance these both. We'd either be on the extreme fearful side, or we either try to be extremely greedy or sentimentally attached with our investments sometimes. Hence, our emotions can cloud our judgment and lead to impulsive or irrational financial choices. Procrastination is another obstacle we face. Instead of taking proactive steps to address financial challenges or to pursue our goals, we delay action. We stop doing action, hoping that problems will resolve themselves or that we'll have more time in future. Unfortunately, this tendency towards procrastination only exacerbates our financial woes. Meaning, when we try to procrastinate certain things, what happens is we are putting ourselves at risk, our financial plan at risk, and our clients' aspects as well at risk. So, which creates the spiraling problem of financial worry. Furthermore, we often lack the discipline and the patience. Of course, in our professional life, when we go on to audits, when we go on to assignments, we are definitely disciplined and we have a lot of patience when data doesn't come. We continuously follow up with the client, be it for audit documentation and your verification, be it for GST filing, be it for TDS filings. We as professionals have a lot of patience. But when it comes to our discipline, our patience, our financial well being, we are the most indisciplined professionals ever to plan for ourselves and for our family. This statement might be very harsh, but it is the ground reality in today's world. So, what we should understand from this is for long term financial success, we should be disciplined, we should be having a lot of patience, and we struggle sometimes and many a times to stick to a budget. So, I'm sure everybody is aware on how to prepare a budget for our clients, how to review a budget for our clients. But what happens when it is for yourself, for your life? Do you have a budget on a monthly basis? Or do you just experience life on the go. That becomes very crucial. So we struggle to stick to our budget, and sometimes unnecessary expenses creep in. That is very unfortunate of things, but we cannot do. So what we should do is we should consistently have our savings in place, which are emergencies in nature, and whatever is the surplus we have beyond our emergencies. Emergencies can be, let me take a minute back and explain what emergency is required for. Let us say for a chartered accountant who's running his own practice, and he's running in a tier 2 city. For example, let us say Madurai, a chartered accountant in practice, is having a setup in Madurai. Let us say to run that setup, his monthly minimum expenses to open the office, have one staff, have one office boy, have the electricity, have the internet connection, run the laptop, pay for Tally yearly subscription. Let us say it boils down to 20,000 rupees of expense per month minimum. Now, when it comes to saving, you should always have 10 months to 12 months of your monthly expenses into savings, into ultra safe, into relevant financial instruments. Let's say, for example, fixed deposits or liquid funds, and parked it aside so that, let us say, an event happens where you are having a health setback, or somebody in the family member is having a health setback. There, what you can do, you can tap into these savings. Of course, there will be a negative impact on two fronts. One, your practice, you will not be able to concentrate full time. Second, you'll have the financial worry. So the first plan which we go about is having this savings in place, and then beyond this, whatever we have. So in our example, 20,000 expenses, this is only for running the office. There will also be expenses for running for the home. Let us say home expenses amounts to 30,000 rupees a month plus a rental of 15,000 rupees, 45,000. So overall expenses is about 65,000 rupees. So we should plan ourselves in such a way that 65,000 multiplied by 10 months, 6.5 lakhs to 7 lakh rupees. You should have it in fixed deposit, ultra safe, and it should be easily available. You should not lock in everything. You should have graded time period. I'll explain in this presentation today on how you can plan for that. So when you get into these aspects, you should have this as bare minimum amount sitting with you for your well-being and your family's well-being, just in case if any accidents happen. Beyond this amount, whatever is the excess available with you, that you can plan it. Of course, in our educational aspects in the paper of CA final, we have learned how to construct a portfolio. Similar to that, there are professionals available in the market who will help you in guiding on what are the asset classes available, how an investment policy can help you keep yourself at peace, how the asset allocation can you work for yourself. The security selection aspect, either you can research or you can ask your investment advisor to research for you and give it to you. And finally, you can peacefully keep this money either in one go, or you can park it over time by systematically investing either through systematic investment plans or through other means. Let us say you manually do it monthly. You can create this pool of investments and then plan for your other aspects of your life. Okay, this is the small interplay between savings and investments. So we should resist the instant gratification ka temptation. And when we do that, we will end up having lot of biases which can distort our perception. Because we as human beings and as chartered accountants have the knack of speaking to many people over the place, and we try to take everybody's advice and other things. So that can help in come our way of financial planning. I can give you a small example. Me being a chartered accountant as well, me being a financial planner as well. What happens is sometimes I am not in favor of investing in physical gold. This is my personal example. I am not in favor of investing in physical gold. Alternatively, what I do is I am very much comfortable in investing in gold either through mutual funds or through digital mode, through sovereign gold bonds and other aspects. It is not that I don't want gold. I don't want gold in physical form. So this is my bias. I don't want to hold physical gold. I want to hold a gold as an investment in my portfolio, which creates a bias and can distort our perception of reality and lead us to astray in our financial decision making. This is mainly predominantly linked with confirmation bias, anchoring bias, loss aversion. All these are bucketed under cognitive biases and can prevent us from making irrational and informed choices. Perpetuating this will perpetuate into financial missteps and missed opportunities. Overcoming these obstacles requires self-awareness, education, willingness to confront the uncomfortable truth. By cultivating resilience, humility, and disciplined approach to financial planning, we can navigate these uncertainties of the financial landscape and achieve our long-term goals with confidence and clarity. Moving further, this is few minutes on basics of financial planning. Let me spend few more minutes on explaining you what are the steps in financial planning. From whatever educational knowledge, from whatever experience, professional experience which I have gathered in my last 7 years, I have culminated the financial planning into these 10 steps for you. Step one is knowing your current financial position. I'll explain each and every step in detail. Step two is financial goal setting. Comes next is prioritizing these goals, choosing the right financial vehicles by way of investment planning, by way of debt planning, by way of insurance planning. And beyond this, we should create a financial plan, align the plan with the current position, align the plan with the financial goals, implement the plan, and periodically monitor and review the plan. Lastly, when all this is in place, then we go ahead and think about maximizing our savings, which is towards emergency funds, maximizing investments on where we can do asset allocation, and then lastly, combining both and see how we can improve our income and standard of living. This will include identifying what are your risk and rewards planning, what is your tax and cost planning, how your liquidity is planned, and things like that. So let me get deep into this. In this unique post-COVID world, there is no greater time than present to know your current financial position. We as chartered accountants are uniquely and definitely capable by way of our design and our educational background to do this basic assessment. This is very critical. It is like preparing your own balance sheet on what you have and what you owe to people. This is very much critical, crucial, as there is so much uncertainty about life. And we as human beings have very limited mortal life with us, where everybody knows, I'm repeating this again, death is inevitable. We should be prepared. Let's say if it happens tomorrow as an accident or something else, what will the next generation do? What will my family do? Hence, a basic assessment of our current financial position will go a long way in setting our financial goals, prioritizing them. Once we are aware about our financial position, this can be aligned with our financial goals and prioritized, and the right vehicles can be chosen for planning to create a robust and rounded financial plan. Most of the time, financial plan is created, but it is never aligned with a variable change, which the chartered accountant has in his or own life. Let us say, for example, a chartered accountant is there in service working in a industry. And when he is working in an industry, let us say he is commanding a package of 12 lakh rupees per annum. Along with this, the company for which he was working, it has grown multiple in that particular financial year, and it has announced a bonus. Now, 12 lakh salary may 1 lakh per month is the average which he is receiving. Let us say, as in our earlier example, we were trying to give the household expenses to be around 45,000 a month. So from 1 lakh rupees, let us say 45,000 goes away towards household expenses. Let us say he also has a car for which he's paying an EMI of 20,000 a month. What happens? It comes to 65,000. Now everybody will say, boss, 1 lakh is CTC, you told. Obviously, take home salary depending on the old regime and new regime will be slightly lesser. Let us say he has selected old regime and he's able to manage his taxes because he's staying in a rented house and he's able to claim other allowances and deductions. And he's also investing. So what happens is his cash flows become important. So what is on paper as 1 lakh rupees, after taxes, it comes down to, let us say, 85,000 rupees. From this 85,000 rupees, he is already spending 65,000 rupees a month by way of expenses for his home and EMI for his car. So I'm assuming the home expenses are including all the food and other expenses which is there. So from 85,000, if we remove 65,000 of expenses, we are left with 20,000 rupees. When I started my example, I was explaining that you should have at least 10 months of your expenses into savings, and anything above and beyond that should be in investments. Let us say he's a first generation chartered accountant and he just started his career and he's drawing 1 lakh rupees per month. After tax, he's drawing 85,000 rupees a month. After all his expenses, net in hand, he's having 20,000 rupees. Now, with this 20,000 rupees, what should he do? Whether he should do a savings or whether he should do investments or whether he should do a mix of both. So here is the complexity which involves, and here is the benefit of financial planners which will help and guide you. Now let us break this 20,000 into 3 buckets. One bucket, let us say 10,000 rupees, we will park it for very long term goals. The long term goals can be buying a house, right? Upgrading lifestyle. These are all very long term goals. We can park 10,000 rupees in the investments bucket using an asset allocation plan. Okay. And we can do security selection and let the money run for its course. Balance are left with 10,000 rupees. Let us break that down into 2. 5,000, we can keep parking it every month for our savings aspect, right? In a year, we will be saving about 60,000 rupees. Agreed? Now, this amount will never be constant. I was just explaining the power of compounding and the inflation which is there. When the power of compounding kicks in, this 60,000 next year, when it is reinvested again, it multiplies itself. That is power of compounding both on the savings side and on the investment side. When it comes to inflation, your package next year will improve as well. So your 5,000 ka share will also have to go up. This is a very small plan, which I'm trying to explain and put it across on how you can optimize this. The last bucket of 5,000 rupees, which is there, I know I should not be saying this, but if preferred, either choose between paying off your debt which you have taken. Let us say you have a car EMI which is going on, or put it in the investment buckets. Don't put it in the savings bucket because you will surely have a very rounded approach. So this is how a financial plan should look like, ideally. But what happens is when we get this, we try to get carried away and we try to use all our savings and we burn our savings as well. So most of the time, the financial plan is created, but it is never aligned with the variable change which the chartered accountant has in our own life. Same is directly correlated when it comes to managing a financial plan for our clients. We are aware about the client's lives and more aptly keep moderating the current position and account for a variable change with their goal. We should also account the same things for ourselves. The most easiest of the task among all these steps is the implementation of the financial plan. Why and how I'm saying this is easy is because once you have the clarity of thought on what goes where, how you can plan, the implementation, the security selection, the asset allocation becomes very, very simple because you have clarity on what you need, where you need, how you need, right? This is the most easiest of the task. Now, when this plan is aligned with the goal, this can effectively be achieving the balancing your maximum savings and investments from liquidity, cost, tax, planning, risk, and rewards. This is a very wide gamut of explanation, which I've covered it in the subsequent slide. I'll reiterate over there. I'll not cover it over here. Coming back to this, as chartered accountants, we are mostly familiar with knowing the financial position of our clients. You will agree with me on this. We assist them in goal setting. We assist them in prioritizing their goals. We help them in choosing the right financial vehicles. We help them in creating a financial plan. We help them in aligning their plans with their goals. We help them in implementing that plan, which is the easiest of the all. We help them in periodic review and monitoring. Probably they should pay the fees. And we help them enabling and maximizing their returns. We should also replicate all these things for ourselves, for our lives, and for our families. Have we ever done this kind of an introspection? After all, what do we make ourselves capable of if we are unable to apply our knowledge and skill set gained through our professional qualifications and experience, which is not utilized for our own benefit? Right? Now, financial planning inclusions. So, always there is a vision and the current situation. When current situation is there, when you have certain vision, how do we get there is what we always aspire to be. Correct? Most of us have goals in life. Most of us have aspirations in life, be it in practice, be it in service. Right? How do we get there if financials are involved? Our personal financials are involved. So, it is rightly said that our current situation will never determine our future. Similarly, where we are today, we can always take charge of our current situation and aspire to move ahead in life. One small joke over here. After all, if a chai wala can do it, why can't we? Please excuse me for this. So today, we find ourselves at a pivotal moment in our financial journey, poised between our current reality and our aspiration for the future. Our present financial landscape is characterized by combination of achievements, challenges, opportunities, reflecting in the culmination of past decisions and actions. We may have attained certain milestones such as stable income stream, asset ownership, or debt reduction. But we also confront obstacles such as fluctuating markets, economic uncertainties, and evolving life circumstances. Amidst all this complexity, our aspiration provide a beacon of clarity guiding us towards a future which is defined by financial security, abundance, and fulfillment. We envision a scenario where our financial goals, whether they involve a home ownership or retirement readiness, educational pursuits, entrepreneurial endeavors, or philanthropic endeavors, they are not just aspirations but tangible realities. We strive for a state where we have not just aspiration, where we have achieved a harmonious balance between financial stability, personal fulfillment, where our resources are aligned with our values and priorities. To bridge this gap, our current reality and our desired future, we recognize the importance of deliberate planning, strategic decision making, and disciplined execution. I am sure there is, I'll take a side note over here, sidestep. Most of you will agree GST has n number of implementation challenges. The new portal of income tax had n number of implementation challenges when it was done in the first year. GST even today everybody is fighting and has very less clarity on where everybody is heading. Of course, we are more rich in now experience in handling situations, but the clarity and the thought process and the systems are still evolving, are still accounting for variable change. When that happens, the same thing applies to our financial planning as well. So, to bridge this gap of our current reality with our desired future, we recognize the importance of deliberate planning, strategic decision making, disciplined execution. We should commit ourselves to expanding our financial knowledge, cultivate some positive habits, and seek guidance when needed. With determination, resilience, and a clear vision in mind, we embark on this journey towards financial empowerment and prosperity, confident in our ability to navigate these challenges and seize the opportunities along the way. There is one famous author by name Jim Rohn. He said this about humans. We should take care of our body. It is the only place you have to live. Similarly, we should take care of our financial position to take care of our body. Now, moving further, what are certain financial planning skills? In this, I'll be covering what are the financial planners basics. Excuse me. I'll be covering who can be a financial planner in India, who can be a financial planner globally, why is financial planning relevant in today's landscape, what are the benefits of becoming a financial planner. Of course, we are chartered accountants, we'll know what are the benefits of becoming a financial planner, and how is financial planning different from succession planning. Let me deep dive on this. In India, there are various ways in which one can become a financial planner. Some of the prominent financial planners have the following educational qualification. There is something called as certified financial planners, which is accepted globally and in India. We as chartered accountants are very much known for financial planning. Let us say you're taking a journey. Let us say I am taking a journey from Chennai to Madurai in Tejas Express, right? One fine morning, there is a businessman sitting beside me when I'm traveling in train, and we just casually strike a conversation. And about during the conversation, I understand that he's a businessman and he's very successful in his life. And at the same time, I end up telling that I'm a chartered accountant. The very first question he asks is, "Sir, how can I reduce my taxes?" It is very funny and it is very ironic that being after being so much successful, everybody's intention is to reduce taxes and other things because we see it as a burden. But it is actually a tool to develop nation. We are still developing. We are still a developing economy. We have not reached what US has reached. So yeah, it is good to have taxes. Now, chartered accountants are very good in answering as well. Sometimes we give free advices, but that is okay. Next, moving on. Who can be a financial planner? So there is an exam which is conducted by National Institute in Securities Market, series number 10A and 10B on registered investment advisors. They are approved by SEBI. So all you have to do is take that exam. It's a two-module exam, 10A and 10B. The question paper type is given in the first few pages itself. The syllabus is almost on par with what is covered in our educational qualification when we try to qualify as a chartered accountant. It is a culmination of financial management paper and taxation paper. Some bit of ethics is involved, some bit of code of conduct is involved because that is what is expected out of registered investment advisors because SEBI takes these things very seriously. They don't take it very lightly. So you should be educationally qualified when you are trying to advise for clients, right? First step is to take that exam of registered investment advisor. Next step is there will be an interview conducted by SEBI before giving you the license. And once you clear that interview, you will get the license of being a registered investment advisor. Who are the other financial planners? Mutual
Sir,
fund.
sorry to interrupt. Can you
Huh?
put it some audio voice?
Sorry, sir.
It's not more audible.
Is it fine now?
Yeah, it's fine.
I'll just move the mic near. Yeah. Sorry. So, who can be a financial advisor, a financial planner in India? Mutual fund distributors are also capable to do it. Similarly, there is an exam called NISM 5A. If you clear that, you become a mutual fund distributor. When you prepare for the exam, you will learn on how to do financial planning. And commonly, when you go to your banks and other financial institutions, you have bankers and financial advisors who are financial planners as well in India. Globally, almost similar set of professionals also are known as financial planners. Like how chartered accountants in India are there, globally certified public accountants are there. Like how a certified financial planner is there, globally also certified financial planner is applicable. How a registered investment advisor is there, globally chartered financial analysts and chartered financial consultants are the equivalent of them. And of course, bankers and financial advisors are also financial planners. In today's landscape, financial planning is indispensable due to numerous factors. With increasing life expectancy and shifting the retirement dynamics. Now, if you see, when I speak about retirement dynamics, lot of people who are 60, 65 plus are independent directors in multiple companies and are very successful in turning around some companies. So there's no right age of retirement. And there are a lot of people who retire at the age of 30, 35, 40 as well. If you follow Twitter, there are a lot of people who retired at the age of 35 and build their corpus and then eating it out of their corpus. So in this way, retirement dynamics has shifted. With this, what happens is there is an economic volatility. Every now and then you hear about some war or some issue or the other. So economic volatility is inevitable. We have our healthcare costs, which are rising day by day. And as I was saying earlier, inflationary pressures are also there. All these put together underscores the need for proactive financial strategies. Additionally, globalization and technological advancements bring both the opportunities and the risk, bring both the opportunities and risks. This necessitates strategic planning to navigate these complexities. A comprehensive financial plan provides a roadmap for individuals to achieve their goals, manage the risk, adapt to changing circumstances, whether preparing for retirement, saving for education, or managing debt. Financial planning empowers individuals and makes informed decisions and secure their financial future amidst all the evolving landscape. When we speak about the benefits, it includes all such opportunities to make a positive impact on the client's life. Simultaneously, we should also have to make a positive impact on our lives by helping achieve the financial goals through navigating complex financial decisions. Financial planners provides intellectual simulation and they have continuous learning opportunities due to vast regulatory changes. Who better than chartered accountants know about the various regulatory changes which happen almost on a weekly basis? This is how industry develops, this is how industry evolves. Similarly, our financial plan also should align with these. The financial planners also have the ability to build long term relationships with clients. And moreover, financial planning offers a rewarding career path with opportunities for professional growth and achievement in dynamic and evolving field. Financial planning involves creating strategies to manage an individual's or organization's finances effectively, focusing on areas such as budgeting, savings, investments, retirement planning, risk management. It aims to achieve the financial goals in ensuring long term financial securities. And on the other hand, succession planning is the process of identifying, developing future leaders within an organization, if you're in an organization, or when you have a family, who will be the next kith and kin who will be able to take your legacy forward. Gone are those days where people want a male child to take the legacy forward. Women are more capable, more empowered, and more vigorously approaching this, okay, in succession planning, so that there is a smooth transition of leadership. It involves assessing talent, whether be it in the family succession plan or be it in your client succession plan. All right. And when financial planning deals primarily with managing financial resources, succession planning will lead to how your leadership continues, how your legacy continues for yourself and your practice. Let us move further. One very great question: can you be a financial planner? You, as a chartered accountant, can you be a financial planner? Simple answer is yes, you can definitely be a financial planner. All you need to do is have the knowledge, which we already have from our educational background, from preparing for our client, from preparing for others' financial planning. Right? We should have the relevant expertise, which I'm sure everybody is educationally qualified to have the expertise. Our credentials are more than sufficient. It is more than sufficient to be calling ourselves as chartered accountants, as financial planners. Giving it a perspective, financial planners are a good perspective oriented people. And last but not the least, common sense. This is where I believe most of us miss out, that we don't use our common sense. So that is quite strange. But now let me deep dive into how we can become a financial planner. Financial planning is a multifaceted journey that demands the integration of all these five elements, which I just described, of knowledge, expertise, credentials, which we already have, perspective, and common sense. These components forms the bedrock upon which successful financial planning careers are built for our clients and for ourselves, each reinforcing and complementing to others and create a solid foundation. Knowledge is at the heart of it. Knowledge is at the heart of financial planning. We are very much capable. We very much follow the news. All right. This lies the comprehensive understanding of financial concepts, which we are aware, financial principles, which we are aware, financial strategies, which we are aware. Financial planners also must possess broad knowledge across various domains, which we chartered accountants are very much capable, including investments, taxation, retirement planning, insurance, and estate planning. The depth of our understanding in all these aspects enables us to analyze our position and our client's position and identify opportunities and tailor these opportunities and curate a plan. How we can do this? Continuous learning and staying abreast of the industry trends and regulatory changes are essential to maintain the expertise. Who better than a chartered accountant to know about all the regulatory changes which are applicable for ourselves, for our taxes, for our investments? Like, for example, last year, if you see, there was a change in taxation scheme from 1st April 2023. Whatever debt mutual funds instruments, whichever were there, they were no longer bifurcated between long term and short term, just to give a level playing field. Everything is now taxed as short term capital gain at the maximum marginal rate, which is the slab rate of the SSE. So we are aware about this because we follow the budget very keenly, right? Chartered accountants are tax experts as well. Moving to experts category, knowledge alone is not enough. Financial planners must also possess expertise in applying that knowledge effectively, which we very much do. Expertise is cultivated through practical experience, which we most ofly have because of our intense articleship training and all those things, right? Even though now institute in the new scheme of things have cut down the 3-year period to 2-year period, I am definitely sure that this will not impact the quality. We have hands-on involvement in financial planning scenarios. We during our articleship would have definitely gone through some tax planning aspects. Tax planning aspect is one of the common denominator in the scheme of financial planning. By working with diverse clients and navigating complex financial challenges, financial planners develop these skills and judgments necessary to make informed decisions, solve problems, and achieve optimal outcome for client. Who better than chartered accountants are good at solving problems? Who better than chartered accountants are good at optimizing costs? So we are expert. We also have the relevant expertise. We should just apply for ourselves. Credentials, as I was telling earlier, on globally who can become financial planners, and in India who can become financial planners. Credentials are just an entry point, a way to keep your card for your client, and an introspection aspect that we are aptly capable on this financial planning journey. While knowledge and expertise are definitely crucial, which we were discussing, credentials just give a validation and credibilities in the eyes of clients and peers. Obtaining that recognized certification, such as the certified financial planner or as a chartered accountant, we demonstrate commitment to professionalism, to ethics, to competency, and to financial planning. These credentials signify a level of rigor and proficiency that instills trust and confidence in clients, enhancing the credibility and reputation as a financial planner. The fourth and the most important aspect is perspective. Perspective is nothing but a lens. Today I'm wearing these glasses. Why am I wearing these glasses today? Because my vision is slightly different. I cannot see it very clearly. So I have to wear these glasses to correct my visions. Similarly, when we are seeing ourselves, when are seeing our current financial position, when are seeing our client's financial position, we should wear an appropriate lens in front of us. The type and the category of lens which we wear becomes very important in knowing about things, understanding about things, and that gives a different level, a different perspective in life. So the perspective is effective in not only encompassing our technical expertise, but also it should include empathy, and we should communicate for ourselves. When we do this, when we come with a holistic view for our lives and for our clients' lives. By doing this, we also know how much risk we can tolerate and at what stage of life we can tolerate. This gives us insights in giving personalized recommendations for ourselves and for our clients. Last but not the least, a very important common denominator is the common sense, which I'm sure is not very common these days. Amidst all these complexities of financial planning, common sense serves as the guiding principle, grounding decisions in practicality, rationality, and sound judgment. Common sense enables financial planners to cut through the noise, prioritize what matters the most, and simplify complex concepts for our comprehension and our client's comprehension. It involves critically evaluating options, weighing risks and rewards, and making decisions that align with the client's best interest and overall financial well being. Moreover, financial planners generally remain humble, generally recognize limitations of our knowledge. We know our limitations. For example, I I cannot expect an internal audit expert to go and do a statutory audit. It is not that he's not capable. I wish a statutory audit experienced person does a statutory audit. It is a similar way. So common sense and knowledge are two completely different things, and professionals should respect this. The overall summary of these things is to become a successful financial planner, you require a balanced integration of all these aspects: knowledge, expertise, financial planner, credentials, perspective, and common sense. By cultivating these qualities, financial planners can provide valuable guidance for your own self and for your clients and make informed decisions and navigate the complexities of the financial landscape with confidence, clarity, and through continuous learning experience and practical expertise, and our commitment to ethical conduct, which makes a huge difference in the lives of ourselves and our clients' financial security. And it brings peace of mind and a brighter financial future. Some of the financial planning skills which we should have are as follows. I'll just take 10 seconds. Just 10 seconds, please. Yeah, thank you. So these are some skills which are there for financial planners. Branding, basic skills. These are all basic skills. Branding, networking, listening, problem solving, and work ethics. All right. When it comes to our own self, do we require a brand? The answer is still yes. We are a brand. We are a chartered accountant. We definitely will be a brand. The society looks to us in a very positive and a vibrant way. So, yes, branding is important. We are very good at number crunching and building relationships, solving problems, guiding clients towards their financial goals and also our financial goals after this webinar today. And to excel in this dynamic field, financial planners must possess a diverse skill set that goes beyond technical expertise. In this comprehensive aspect, these essential skills contribute to the success of a financial planning. Branding. When we tell branding, the brand of chartered accountant is more than sufficient to give an entry card for you as a tax planner, for you as an investment planner, for you as an investment advisor. But of course, if you have the relevant educational qualifications, which I discussed few slides ago, that will be a added bonus. So branding is just nothing. It's just not like a logo or a catchy slogan. It's about crafting a compelling narrative that sets you apart from the competition, right? Whether be it for your own life, own practice, or in employment, you are your own brand. In the realm of financial planning, building a strong personal brand is crucial for attracting clients and building trust. We start by defining our unique value proposition and what sets us apart from other financial planners.
Sir,
Maybe
something
it's,
louder, sir.
sorry. Maybe it is our specialized expertise in the retirement planning, or our commitment to personalized service, or our innovative approach to investment strategies. Whatever it is, make sure that it resonates with us and with our target audience and reflects our authentic self. Once we have defined our brand for ourselves, it is time to bring to life our efforts of marketing. This, of course, there are certain professional and ethical guidelines within which those parameters have to be adhered to when we are branding for ourselves and marketing for ourselves. This could create this could be by way of creating a very full mode professional website and some engaging content on social media. Of course, nowadays SEBI is coming very harsh on the financial influencers. I'm not telling you to become an influencer, but that will go a long way in establishing your brand and your presence across all the touch points, be it your business card. Of course, CA should have a very reserved kind of a business card, but it is no harm in adding a QR code for exploring your LinkedIn profile. You're not advertising through that, if I'm not wrong. So you're not creating an advertisement, but at the same time, you're showing your strength in brand presence. You'll not only attract clients by this, but also build credibility and you'll have some trust in the marketplace. Next comes networking. For a successful financial planner, networking is a most essential skill. And in this field, this networking hinges on the strength of how much our professional relationship is. And networking is not just about collecting business cards at industry events and other things like that. It is about building genuine connections. Let's say if you're going to a meeting, you have 50 business cards with you. By the end of the meeting, you have exchanged these 50 business cards and you have other people's business cards with you. The ask is, the need for you is just contact 5 of them every week. And in 10 weeks, you'll be in touch with everybody. By 10 weeks, I mean it is how many months? 2.5 months. So once a quarter, you are in touch with these 50 people, understanding about their life, knowing from them, learning from them, and upgrading yourself and establishing your brand. So this is one of the form of networking by attending conferences and exchanging cards. The other type is online forums by way of a webinar today which we are attending. The third forum will be social media. Social media includes LinkedIn these days. There are a lot of LinkedIn groups available with us. So the key is to be authentic and genuine in your interaction, focusing on building a rapport and adding value to others wherever possible. That is the ultimate motive. Whether you're a financial planner or not, adding value to your life and to others' life should be the ultimate motive. Networking is always a two-way street. So just don't focus on what you can get out of it, but also what you can give. And by nurturing your professional relationships and adding value to your network, you'll create a strong foundation for success in the world of financial planning. Listening. Most of us, I repeat, most of us are not good in listening. This is where most of us fail. We don't listen to understand, we just listen to listen. Okay. Listening is perhaps the most underrated skill in a financial planner. It is the subtle messages which you yourself get for your own financial planning and when you interact with the clients. The subtle points which you pick up through your listening skill becomes most crucial. And this helps to give you an added touch and added flavor. Effectively listening involves more than just hearing what your clients are saying, but it is about actively empathizing with them and with their situation, asking thoughtful questions, and uncovering their underlying needs. Similarly, it applies to yourself as well. To hone these skills, practice active listening, such as paraphrasing, summarizing, and asking and clarifying questions. Make sure that clients give full attention, eliminate distractions. By eliminating distractions, I am sure half of the audience now who's in this webinar is having a mobile listening to me and parallelly doing their business as well. Try to avoid these distractions. Listening is not just about hearing words, but understanding emotions and motivations behind these words. If you have mastered the art of listening, you are equipped to tailor your recommendations to clients' unique needs and build deeper and more meaningful relationship in the process. Problem solving. Chartered accountants are very good at it, turning challenges into opportunities, which is a core competency for financial planners. As clients often come to you with complex financial challenges, I am recently advising a client not only on their financial aspects, but also on how they can improve their sales, how they can improve their margins. So we play a multifaceted role, how to optimize their taxes and how to navigate through this volatile market. What better they can do from competition to achieve optimal returns which they have envisioned. So these kinds of problems can be easily solved, including for our own self, by breaking down these complex issues, identifying the root causes, and developing innovative solutions that address our clients' needs. Work ethics. The foundation of trust and integrity is work ethics. You should be ethical to yourself, you should be trusting yourself, and you should be having worked with integrity. This is the foundation for success in financial planning and in your own self financial planning. As a trusted advisor, your client will act on your advice, will act on your honest and integrated advice, will act on your honest, integrated, and professional advice. Right? This means putting clients' interest first when it comes to clients' financial planning. When it comes to your own financial planning, your interest should also be first. And adhering to the highest ethical standards. You should have certain standards. If it is a no, you should be able to tell it on face that no, we cannot work like this, boss. So that confidence, it is not harshness or rudeness, it is just establishing your point. This trust is earned over time and through consistent actions. As I was telling few moments ago, when you go and exchange your cards, let us say you exchange 50 business cards, at least try to contact them once. So Once a quarter, you will be in touch. You will have their life update. You will share your life update, and you will progress in this journey, and it will be mutually beneficial. To conclude all these aspects, mastering the art of financial planning requires a diverse skill set that encompass branding, that encompass networking, listening, problem solving, and work ethics. By these skills, financial planners can not only attract clients and build successful practices, but also make a meaningful difference in the lives of their clients. Whether you're just starting out in this field or you're looking to take your practice to next level, these skills may invest in will be of core competence. Moving forward to the next aspect on what are certain financial planning tools. I'll be explaining you these by way of three stories which are there.
What was a
Hello.
yeah?
But I'll be explaining these financial planning tools via three stories. So, can anybody guess on what this is? I am sure most of us have heard it in various seminars. Sorry. Sorry. Yeah. Can anybody guess on what this is? I'm sure most of us have heard it in various seminars about this bridge. It is the famous bridge to nowhere, the Chaulitaka Bridge. It is a 484 meters long bridge in Honduras, Central America, in a region that is very notorious for storms and hurricanes. This bridge was built in the year 1998 by a Japanese firm, and the bridge was a modern marvel of engineering designed to withstand the powerful forces of nature, including storms and hurricanes that were prevalent in that region. But within the same year, what happened is that bridge was commissioned for use, and Honduras was hit by a hurricane named Mitch. So we have the habit of naming hurricanes. This hurricane's name was Mitch, which caused a considerable damage to the entire nation and its infrastructure. The river, which was supposed to flee, many other bridges, roads, and infrastructure were damaged. But this bridge survived in near perfect condition. More impressively, the Chaulateka River had caused the forced floods to carve around it, as you can see it in the image, and not under it. The purpose for which the bridge was built therefore became lost, and the flood waters were no longer flowing below the bridge. That is why the name Bridge to Nowhere. From this, we learn three lessons, which are culminating into tools in few minutes. Lesson one is most often we focus on creating the best immediate stopgap solutions for a given problem, forgetting that the problem itself might change. And we focus on building the most sophisticated products or services without thinking that requirements could evolve or markets could vanish. Second lesson, it is imperative for our leaders to be slightly flexible, to understand when to administer change, to avoid obsolescence. Whilst this bridge to nowhere was able to withstand the storm and remain firmly anchored, the river found a different route instead. That is how storms of life can at times cause us to re strategize our goals. And the last lesson, the evolving global transformation has directly impacted people's life, businesses, and careers, demanding their adaptability to change. And for instance, a closer review of one's career is paramount before taking additional learning and development in specialized expertise function. This is because certain roles and expertise could have been declared redundant. Now, what this means is everybody is scared that artificial intelligence will take away jobs of chartered accountants and many other professionals. But if we uniquely strong arm ourselves in understanding this artificial intelligence, I am sure we can tame it, we can use it for our benefit, and we can benefit from this as well, and our clients. The three simple tools to learn from this bridge is: pay off your debts and use only as a leverage. Try to be debt free as early and as soon as possible. Take calculated risk and safeguarding our lives. Life is very unpredictable. Our profession is also very unpredictable. Take appropriate insurance, term insurance, life insurance, health insurance. All these are important and crucial. Also, prepare your mindset that accidents can happen, like this bridge. The river started flowing beside it. Use your common sense and try to avoid any deep impacts from this. The next story is very relevant in today's terms when it comes to financial planning journey. Professor Ashwath Damodaran, the valuation guru, explains this interesting story of lemmings in his valuation lectures. So lemmings are small creatures with wild reputation. They are rodents in nature and comes in the rat category. Around 17th century, what happens is they are naturally perplexed by the habit of Norway lemmings to suddenly appear in large numbers, seemingly out of nowhere, came to conclusion that the animals were being spontaneously generated in the sky and falling from the earth like rain. Some people also thought that lemmings explode if they become sufficiently angry. This is also a myth. Of course, lemmings are indeed one of the most irascible rodents, but excuse me, excuse me, but they mostly channel their rage into fights with other lemmings. There is one myth that has tenaciously held on. Every few years, herds and herds of lemmings will commit mass suicide by jumping from the cliff. Instinct, it is said, drives them to kill themselves when their population becomes unstably large. Now, this particular myth is based on their behavior. Their large population booms every 3 or 4 years. When the concentration of lemmings become too high in one area, but lemmings can learn to swim. In financial planning, you must always remember, never follow the herd. What is applicable to you may not be applicable to others. What is applicable to others may not be applicable to you. What you curate for your client may not be replicated for yourself because the risk appetite and the asset allocation and the investment policy is slightly different for your client than what you can do it. But at the same time, be sure about your capabilities, never overestimate it, and do not try to manage risk, but aim to know the source of risk, whether in business, whether in profession, whether in personal finance, on where the risk can come from. You cannot curate it, you cannot terminate it, or you cannot transfer those risks, but you can be aware about those risks. Analyze the fault lines on what may go wrong and be aware about it. For example, currently elections are running up. There is a talk in the market that stock markets may crash if the BJP government does not comes to power. All these news will be there, but the markets will continue to go on forever. Whether you take the history and see of any country, be it India as well, markets are known to give you temporary reaction, but not a permanent damage. And when the tectonic shifts happen, regulatory or statutory changes happen, move from incremental mindset to exponential mindset. Never become greedy or speedy when doing financial planning and wealth creation. Be it as boring as it may sound, use it wisely. This is also one of the financial planning tool about the experience on how our mind thinks and how it interacts. It is put across by way of a very beautiful story. Let me start my story with this video. Let me share the video as well. Just give me a moment. Just a moment. I'll put the video across. Just a minute, sir. I will just put it across into screen sharing. Let me know when the is, please.
Hello,
Is the video audible, please? Let me know.
everyone. Thank you so much for coming to help us conduct this experiment today.
We were of different ages. We were made to like stand in a line.
Now, I'm going to ask you a bunch of questions. If your answer is a yes, step forward. If it's a no, please step back. Here goes. Ready? Did you learn how to ride a bicycle before the age of 10? Did you learn music in school? Did you take any lessons in sports? And no, video games are not a sport, even if it has the word game in it. Did you learn how to iron your clothes while still in school? Take a step forward. If not, take a step back. If you can make tea or breakfast, not just for yourselves, please step forward. If not, take a step back.
In the beginning, I think the questions were more general. People were still going forward and backward. Questions like, it was funny to see like the cooking question. There were a lot of men who went ahead and there were women who were going behind.
Do you usually make all the household bill payments yourself? Do you know the circle rate in your area? Do you know the price of gold today? Do you know the exact breakup of your salary?
As the questions unfolded, the stark difference came out visibly.
Do you know the details of the financial documents you're asked to sign? Have you bought a vehicle in your own name without consulting anybody? Have you bought insurance policies unassisted? Do you watch or follow the budget?
Like you think you're doing okay, but then you're like, okay, these are kind of important things that I don't look at.
Do you manage your own finances and earnings unassisted? Do you know how to invest in mutual funds? Do you know the difference between a mutual fund and an SIP? Do you make the investments for your family members or your spouse? Do you file your own income tax return? Now, everyone who's in front, could you please turn around and look behind you? Initially, when you guys started moving, there wasn't such a big gap. My question is, when did this gap start to occur?
The minute the questions became about managing money, the gap between men and women became very clear and evident.
Women handling certain responsibilities regarding their own life, which were always passed on to someone else in the family or the men.
There was a slight unfairness I realized at that time. But at that point, it seemed normal.
I was upset. I wanted to be at the front of the line. It's like, why don't I know this? Why am I not confident enough to say, yes, I am able to understand this?
It was quite an eye-opener for me because I always depended on the men of the family to take care of my investments and, plan my future.
I felt that obviously men are more into it than women. So eventually I did expect the gap to be there.
Over the years growing up, there were certain very traditionally masculine tropes that were assigned for him and certain traditionally feminine tropes that were assigned for me.
For women, it's practically debarred to learn to know and to focus on money.
I wish I had known from the beginning of my childhood and kind of thought about that I would be doing so much better.
Just actionable measures is what we want, really.
Let me put back the presentation. this was sorry. So this was an experiment which was conducted by Paytm about 3 years ago, called as the Divide, a social experiment, which puts forward a question to us on gender equality. It is quite interesting to note that 3 years ago, this gender equality had come up, and at the same time, in the markets, one of the best and the most knowledgeable mutual fund manager, Miss Roshi Jain, who's currently with HDFC, female, currently manages about 70,000 crores of money in mutual funds of HDFC. So it is not only a man's world in this financial journey and financial planning journey. It is the role which was ought to be gender neutral, but over time, due to various reasons, it became more tilted towards men. Anyone can be a financial planner with the skills and with the steps and with the basic understanding if they get it right, by possessing the appropriate financial tools, and they can do wonders. But the only downside is if you do something very interesting and unique, you may not always win. Financial planning is boring. Financial planning is boring. Financial planning is boring, but it is very much relevant in today's landscape. Let me move further. Setting financial goals. So, I am sure everybody, pardon. Yeah, financial goals. Financial goals serves as the guiding principles for individuals, helping them navigate the complex terrain of personal finance and all those things. Inflation and its understanding is very, very crucial because inflation is one aspect which erodes the purchasing power. The rate at which the general level of prices of goods and services are increasing, it is very much evident that our purchasing power of money will decline over time. So we should always be aware and conscious about factoring for inflation when we come to financial planning and when we come to evaluating the financial goals. Another aspect is the importance of time value of money. 100 rupees today is not the same 100 rupees 1 year down the line, is not the same 100 rupees 15 years down the line. That's where time value of money comes in. That's where the power of compounding comes in. As I started my presentation, I was explaining about maximizing in returns on savings and investment. So our job is to find a balance between what investments can be and what savings can be. Basis the expectations, the time horizon, the risk tolerance, we can construct an investment portfolio across different asset classes. By adopting a long-term perspective, and individuals can mitigate risks and maximize returns to achieve their goals. In the later slides, I will explain on how to do that. The retirement planning is one of the aspects, is one of the driver in financial planning. It is not a separate umbrella. It is a subset of the financial planning. Estimating on what the retirement expenses could be is an art by itself, and at what age the retirement will come in and what are the income needs at the time of retirement, that can only be envisioned. It can just be planned. We can put the plan in motion, and when the actual event happens, we can account for variable change. The lastly in this aspect is costs and taxes. So whenever you try to plan your finances, be aware about the cost of the financial planning, not only the fees which you would be paying to the financial planner, or not only the fees which you would be charging from your clients, but also when you construct their portfolio. The portfolio can be divided between various asset classes. The various asset classes I'll be covering in a minute or so. There, each asset class investments will come at a cost. Nothing is free in this world. Everything comes at a cost. There is no such thing as free lunch. And when we are planning for cost, we should always be mindful of the taxes as well. And no better than chartered accountant can be tax efficient managers. So we should be aware of the following. Moving on, we should also be aware about all these aspects. Death is inevitable. Planning for death, we can make it. It is very crucial. Divorce, either in marriage or in profession or in your practice or from your job, it is an accident which happens. We should be mindful about it. Job loss is also a very crucial aspect. To maintain the continuity and our systematic investments, we should plan for redundancies. Accidents are very common, which happens to our health, which happens to our profession. It can be initiated through regulatory change and etc. And lastly, being aware about disabilities, because we cannot guarantee the well-being of our health forever. So we should factor some aspects towards disability as well. Now, how can I improve? As I was saying on the asset classes, globally and in India, there are 5 asset classes. I'm sure everybody is aware about equity, fixed income, commodity, real estate. What may be new is alternate investments. Alternate investments are on par with your private investments, your investments in startup. So all these asset classes which you're seeing, equity, I'm sure everybody knows what is Nifty, what is Sensex, what are stocks, and how stocks trade on stock exchanges. Those companies which are listed, that comes in equity. Fixed income are bonds, debentures, debt instruments, fixed deposits, government instruments, government securities, T-bills, T-bonds are all fixed income. Mixed market linked debentures, zero coupon bonds are all the examples of fixed income. Commodities includes various aspects, most prominent and predominant being gold, followed by silver, aluminium, and the others. Real estate can be broken down into 2 or 3 aspects: commercial real estate, residential real estate, and nowadays very much prominent are coming as real estate investment trust, which own the real estate assets and derive income out of it. That is somewhere between real estate and alternate investments. In this way, one can construct a portfolio based on these asset classes. When these asset classes are in place, what happens is there is something called as an investment policy statement. I'm sure we as chartered accountants appreciate the chart of accounts which we prepare for our clients, wherein all the trial balance line items we give a code and prepare the chart of accounts on how it goes, right? Similarly, an investment policy statement captures all the minutest details about the client behavior, about the client's liking, disliking in terms of investments, in terms of savings and other things. And once you note down all these aspects, that becomes a statement. You and your clients can sign off on this statement. Based on the statement, you can do the asset allocation among these asset classes, right? Asset allocation means how much proportion based on my risk capabilities I can invest in equity. I can invest in fixed income. Equity and alternate investments are the most highest risk bearing assets. Commodities are hedge assets, and fixed income, as the name suggests, it derives fixed income. It is the least riskiest of them all. I'm not saying it does not carry a risk, but it is the least riskiest of them all. All right. So investments into these asset classes is decided from the investment policy statement based on asset allocation. Let us say today we are trying to invest, let us say, 1 lakh rupees. Out of 1 lakh rupees, how much proportion should go in equity? How much proportion should go in fixed income? How much should be in commodity? How much should be in real estate? How much should be in alternate investments fund? It's decided by this investment policy statement. Let's say an investor is ready to take good amount of risk. How will I construct a portfolio? I'll give more allocation towards equity, little lesser towards fixed income, little lesser towards commodity, little lesser towards real estate, and probably nothing on the alternate side because it is just 1 lakh rupees. AIFs require minimum of 50 lakhs to 1 crore rupees. So when we have to choose between these four, equity, fixed income, commodity, and real estate, equity will be around 70%, fixed income will be about 15%, real estate would be about 5%, and balance 10% we can put it in the commodities. This is what is for generally an aggressive investor. Like that, we need to create templates based on our risk appetite on how we can invest in these asset classes. Once this is decided, security selection is the next aspect. How can I take an exposure in equity, in fixed income, in commodity, and in real estate? All this is possible through direct investments or through mutual funds. Through mutual funds, if you do, you need not worry about how it will perform. Take the history, take the track record, see the certainties, take some calculated risks, and invest through mutual funds so that the performance anxiety and the performance accidents can be avoided, and the mutual fund manager will take the way in which your portfolio should be managed. That's how you construct a portfolio. Similarly, when that is in place, invest it, forget it, be aware about the variable change which is necessary. Beyond that, no more tweaking is required. That is why I said in the initial stages, financial planning is boring. If you let it run its course, you will have much better returns and capabilities. How can I improve these skills? If you're failing at something, start again. When you're trying to start again, think again. When you're thinking again, have the aspiration to do again. By doing it, what you will end up with? You will end up with researching again. When researching it, what happens? You will learn again. When you learn again, you again develop a plan, a better plan. And when you trust that plan, you should ensure that you never settle and you try to optimize and maximize the returns. With this, I conclude my presentation. Over to Sambitji and Mani Melagai, ma'am.
Thank you so much, CA Dinesh Chawla, sir, for this session on financial planning skills for chartered accountants. Thank you so much, sir. You've actually navigated us through the goals that needs to be set, the tools to be used, the ways of balancing between the investment and savings. So all these have actually helped us to enrich our skills as better financial planners, and we'll be able to tap better opportunities as well as newer opportunities as CAs. Thank you so much, sir. I request CA Satish Kumar, Treasurer and ICASA Chairman of Madurai branch, to come out with the question and answers. Sorry, questions on his side.
Good afternoon, Dinesh sir, and all participants. So the first question is, if a person is a chartered accountant and also a certified financial planner, and he wants to practice in the field of financial planning, and in case of planning in practicing in financial planning, earning commission from mutual fund advisory is the biggest source of revenue. But unfortunately, CA are not allowed to earn commission from mutual fund to professional ethics. Is there any way, sir?
Sir, no. Currently, no, sir. There is no way out of this. Either you should stop signing balance sheet and give up your COP. You'll have to take a balanced call between which is lucrative to you in making more money, either the commission-based income or the practice which makes you more money. So whichever is coming, you cannot run parallelly, sir. At least not in your own name. That is the hint which I can give. Beyond that, I am restricted to answer.
Yes, sir. So the next question is,
if a person's age is 75 years and he wants to do financial planning, and at present he has investments in 90% in equity and 10% in debt, do you have any suggestions, sir?
Yes,
On
sir.
the basis of risk appetite.
So this gentleman is a senior citizen. Currently, if they have been traditionally investing in the equity markets at 90%, the portfolio would have developed and ballooned a lot. And now, because of the uncertainty present globally and considering the age factor and future generation, it is more advisable to go with lesser exposure to equity and trim down the exposure to equity and put more in fixed income. It can be through mutual funds, debt mutual funds. It can be through zero coupon bonds. It can be to simple fixed deposits also. There are competitive pricing available in the markets. I cannot advertise those, but there are really good competitive interest rates which are available in the markets. And you can plan a fixed deposit from that. You can have your equity exposure. Let's bring it down to say 50% or 55%. And balance you can park it with debt. Of course, please be aware about the taxation aspect when you make the transaction. Short term is 15% and long term is 10% plus surcharge plus cess on both.
Thanks, sir. So the next question is, the fair market value of is DLC rate of property or actual payment made, which is taken while calculating capital gains, sir, and for cost index.
It's a tax question. I'll not be able to answer that much with clarity. I'll take a skip, please.
Thanks, sir. Suppose if a person is having a person is earning 70,000 per month, sir, and after basic expenses, he's left with 50,000. How do appropriate this 50,000?
Sir, you've gone on mute, sir. Can you unmute, please? Satish, sir, you're on mute. I lost your voice. Can you repeat the question, please?
Yes, sir. Yes, sir. If a person is earning 70,000 per month, sir.
Yeah.
And after basic expenses, he is left with 50,000
rupees. Yeah.
How do he appropriate between equity and the debt market?
Okay. So I'm assuming this person would be in the range of 30 to 50 of his age, where his risk appetite can be a little higher. So there you can anywhere navigate equity to up to 70% or up to 75% if you're wanting to take additional risk, and balance proportion can be debt. If this person is aged above 50 or 55, I would recommend this equity proportion to come down to 60 and put a 40 debt. Or if it is a senior citizen profession, then I will definitely recommend 50% in equity and 50% in debt instruments.
Yes, sir. So next question is, can a CA who is a financial planner can also be also a investment planner or advisor needs any NISM certification, sir?
Yes, sir. Definitely required, sir. NISM 10A and 10B are the two exams which you should clear. Once you clear it, if you're already employed with an organization which is into wealth management, then they will take care of applying the registered investment advisor's license for you. Or if you're doing it as a single sole practitioner, then what happens is you'll have to clear some other interview tests with SEBI. SEBI will call you, take interview, and ask you on why you want to do this. The interview will be as strict as an IAS interview, so you should be prepared from all grounds. And then once the SEBI is convinced that you're fit to be an investment advisor, you can definitely be an investment advisor, because you need to have the minimum net worth and you need to pay minimum yearly fees, and how you're approaching the client and how you're communicating to the client, that also is being tested in that interview.
So what are the courses available from NISM, sir?
NISM, there are multiple options available. If you don't want to advise clients, but you just want to be a distributor of products, let's say you're creating a portfolio and you're helping clients to just construct the portfolio and effect that portfolio, you can write mutual fund distributor 5A and PMS distributor 21A exam. These two exams, once you clear, it is again, you'll have to pay the yearly fees to NISM authority for you to get the license, and then you can start practicing for it.
So what is the basic qualification to do this course, sir?
Sir, graduate is sufficient, sir. As we all are chartered accountants, that is much more helpful. And these exams are fairly simpler. They are MCQ based. You get to access Excel also in the competitive exam. 1.5 to 3 hours exams are there. So more details are available on the NISM website. All the subjects on. In fact, the social audit exam is also conducted by NISM only, where chartered accountant can also apply to become a social auditor, which is now an upcoming field of profession which we can tap into.
Okay.
So there's one question as well related to this question. So is there any difference between the NISM registered investment advisor and research analyst?
And sorry?
Research analyst.
Research analyst. Ma'am, research analysts, they are only obligated to publish the reports, research reports. For them to be registered investment advisors, they'll have to clear that exam as well. Or for you to be a registered investment advisor, you need not be a research analyst. So both the things are separate. One is only for researching about what markets are, how stocks can perform, and giving recommendations of buy and sell. The other is advising the client's portfolio, taking the inputs from these reports, advising on the client's portfolio, and executing on these portfolios. So that is the difference between the two. Both exist separately. They are not overlapping each other.
Sir, is there any good draft templates which can be used for financial planning?
So there are multiple customizable templates. What I will recommend is let's start it with a piece of paper and understanding and putting across the summary, and then converting into Excel models. And we are very good at Excel models. So online a lot of free tools are available, but let's start with a piece of paper and noting down what our aspirations and goals are. One pager would be really helpful for the initial discussion.
Okay.
If I template it, because every client and every requirement will be different. Some client may be a senior citizen, but they want to take more active share in equity participation. Some clients will be very junior starting, but they still want a reserved plan. So I cannot give a fixed template. It may not be suiting to everybody.
So then, how to do this stock picking while investing in equities?
Stock selection is an art, sir. I am not qualified to speak, but I'll give guidance on how stock selection can be done. Never only believe on the past performance when you're investing into direct equity. Also take into factoring the current management and what their aspirations are in terms of expansion, where the fundamental growth can come from and where their profitability growth can come from. Technical analysis is one aspect in daily trading, but to create a long-term portfolio, you should have some strong businesses within you. And by researching for these strong businesses, you can invest in these businesses through equity markets.
Sir, do you accept that innovation is also a skill for financial planning, sir?
Definitely,
if yes,
sir.
Can you just elaborate?
Sir, we have to keep innovating, sir. If you see our current landscape, even our institute, our alma mater is innovating and going to conduct foundation exam thrice a year, inter exam thrice a year, because vacuum is there and interns are not there, right? So when it comes to financial planning, the innovation when it comes, the churn in the portfolio, the change what we portfolio to achieve our goals, we should at least do that hygiene check once a year, because we should know where we stand. Because in 1 year you will have some clarity, in 3 years you will have much bigger clarity, and in 5 years you have a big runway. So I request everybody, whoever is having a portfolio, however small their investments are, take a hygiene check, have goals with you. It's like matching A side versus B side. A side will be your goals, B side is your investments. So do this matching analysis at least once a year and see where you stand, whether your aspirations are being met, whether your returns are being met. If not, research better and try to update your aspirations and try to innovate by doing this matching analysis.
Sir, could you tell the name of the bridge in Central America, sir?
Sorry, sir?
The name of the bridge in Central America, sir.
Bridge to Nowhere. You can Google it, Bridge to Nowhere. You will find it.
Bridge to Nowhere. Yes. So for questions are finished.
Okay.
Thank you so much, CA Dinesh.
Madam, you're on mute.
Yeah. So thank you so much, CA Dinesh Chawla, to have patiently handled and answered the questions that were raised by our members and other participants. Now it's time to know about the summary of the webinar that we have had today. So we have CA T Manimegalai, past chairman, Madurai branch, to give us the summary of the webinar.
Madam, you're on mute, madam.
Yeah. Good afternoon to all participants of this session. Come up with the key takeaways session on financial planning for CAs presented by Dinesh P. We Indians are brought up with the good habit of saving. Our savings has to be properly invested to secure our future. We should have modes of investment, variety of modes of investments, and also investment in securities, which must be in different portfolios to reduce our risk. Saving is a great habit, but without investing and tracking, there is no use in saving. It has to grow. Chartered accountant has a financial planner role in the current financial world. He or she should know the characteristics of physical assets, financial assets, and digital assets, and the risk return trade-off, which we expand the core knowledge in the area of investment instruments. Further, this big picture approach helps in understanding how to meet the different financial goals for different clients. To equip CA as a financial planner, CAs should obtain the mastery in personal finance through acquiring technical, communication, and interpersonal skills. In short, if you have goals in life, you need a financial plan for better future. CAs may work on their financial planning endeavors with the framework of ICI guidelines and code of ethics. Financial planners and investment advisors are regulated by Securities Exchange in India under SEBI Regulations 2013, which included financial planning in the definition of investment advisor. It is advisable, in short, to have a variety of investments to reduce our risk and play safe in the investment strategy. Thank you, one and all.
Thank you, CA Manimegalai, past chairman, Madurai branch. Sambitji, Shripriya ma'am is joining?
I don't think so. For the vote of thanks.
Okay, so thank you once again from my side, CA Dineshji. So we now request the Vice Chairman and Secretary of Madurai branch, CA Chairman R, to deliver the vote of thanks.
Good afternoon, all. It has been such an honor to be a part of this wonderful course on the financial planning skills for chartered accountants organized by the Professional Skills Enrichment Committee of ICI. I would like to give a small story from Mahabharata. There are three great warriors in there. They can single-handedly finish the war themselves. So Sri Krishna, Lord Sri Krishna approaches one of the warrior, for which side he could fight for them in the war. He tell that I could fight for that losing team. Because he once started fight for that losing team, the other team starts to lose. So he again shift from the winning side to lose team. Because he's simply, there is no strategy in the war. So what the Lord Krishna do is simply negotiate that warriors from their war. As a chartered accountant, we have the more skills and knowledge Without any strategy and planning, we will also be sidelined from the great war in our profession. On behalf of the Professional Skill Enrichment Committee, ICI, we would like to extend our gratitude to our speaker, CA Dinesh S. Jasawla, for his enlightening session. Thank you, sir. And CA Dr. Anuj Goyal, Chairman, Professional Skill Enrichment Committee, ICI. CA Priya Kumar, Vice Chairman, Professional Skills Enrichment Committee of ICI, for their active guidance. And sincere thanks to the members of the Managing Committee of the Madurai branch of SARC of ICI, who enabled the event throughout. A wide round of applause and thanks to our speaker, CA Dinesh Chawla, the Professional Skill Enrichment Committee ICI, and other stakeholders who made the webcast memorable one. Finally, we would like to thank you all the present here and helping us to make this webcast the grand success. Thank you, one and all.
Thank you very much.